Real estate is intoxicating. The wins feel inevitable. The money feels permanent, from zeros to millions. It's the dream sold on every corner of the internet. The champagne, the luxury homes, the headlines screaming about overnight success. It all feels so close, so attainable. You see the highlights, the victory laps, the stories of people who made it big, but what you don't see on social media are the moments that almost broke them. The silent failures, the empty houses, the for sale signs that represent a dream turned into a liability. The moments when the euphoric high of a big win crashed into the cold, hard reality of a devastating loss. These investors are successful today. Their portfolios are worth millions. They have the kind of cash flow most people only dream about. But every single one of them carries financial scars they rarely talk about. We've spoken with a multifamily investor with 18 years in the game, a developer with over a decade of experience, and a rental portfolio owner with 27 properties. Their stories are different, but their lessons are the same. In real estate, wins are celebrated loudly, but failures are buried quietly. They're hidden behind a wall of pride and a desire to maintain the image of success. And yet, the most expensive, most valuable lessons live in those failures. The lessons that, once learned, can protect you from the very same fate. It's time to uncover those unspoken truths. The first confession: buying too fast. One investor told us the deal looked perfect on paper. The numbers were incredible, the upside seemed limitless. I rushed it. I was so afraid of someone else snatching it up that I skipped critical inspections. I trusted the seller's projections instead of verifying the reality myself. That single decision, driven by FOMO, cost me over 7 figures. The property was a nightmare of hidden repairs. The foundation was cracked, the plumbing was a disaster. The perfect numbers were a complete fantasy. Next, the silent killer: over-leverage. Leverage builds wealth, until it destroys it. Another investor explained, I was using as much debt as I could get. I thought I was a genius, controlling massive assets with very little of my own cash. But when the market shifted just a few points, my entire model collapsed. The properties themselves were fine, they survived the downturn. But the cash flow didn't. The debt service payments ate everything. I was feeding the properties just to keep them, bleeding cash every single month. Leverage magnifies your gains, but it also magnifies your losses, and I learned that the hard way. Then there's the blunder of ignoring location reality. Cheap isn't always opportunity, one seasoned owner confessed. I bought in an area that was supposedly up and coming. I believed the hype that growth was just around the corner and I'd be praised for my foresight. But it didn't come. The neighborhood stagnated. Vacancies climbed, and finding good tenants became a constant battle. The holding costs, the taxes, the insurance, the maintenance on empty units, they just quietly drained everything. My great deal became a slow financial bleed that almost took me under, and perhaps the most painful mistake of all: partnering with the wrong people. The deal wasn't the problem, a developer shared. The partner was. We had a handshake and a vague agreement. I learned too late that our values were completely misaligned. He wanted quick flips, I wanted long-term holds. There were unclear roles, constant disagreements, and a complete breakdown in communication. That one mistake, trusting the wrong person, nearly ended my entire career. The legal battles cost more than the property ever would have made. There was a moment for each of them, when quitting felt like the only logical choice. A moment of complete silence, staring out a window late at night, wondering how it all went so wrong. The money was gone, and worse, their confidence followed right out the door. It's a lonely place that isn't shown in the highlight reels. But the lesson wasn't to stop, it was to slow down, to respect the numbers, not the hype. It was a painful, expensive education in treating real estate like a system. Not a slot machine. They started again, but this time with a blueprint. With deliberate analysis, with verified data, with a deep understanding of risk. The turnaround didn't happen overnight. It was built one smart, disciplined decision at a time, stabilizing what was left and slowly, carefully acquiring the right assets. When we asked them for their single biggest regret, it wasn't what we expected. It wasn't about the money lost or the deals that went south. The biggest regret was ignoring the warning signs, because their own ego was louder than their discipline. It was the regret of knowing, deep down, that something was off but pushing forward anyway. blinded by the potential reward and the desire to be right. Every investor pays tuition. Some pay it by reading books and learning from mentors. Others pay it in millions of dollars of lost capital. At Property Blueprint, we study both. We dissect the wins, but more importantly, we analyze the failures, because that's where the true safeguards are found. Because in real estate, avoiding one catastrophic mistake can be worth far more than finding one great deal. Thanks for watching. If you want to build your own success on a foundation of proven knowledge, make sure you subscribe.